Good morning, good afternoon, and good evening. Whatever time you're listening to this, please welcome to the Market Color Podcast. This is a weekly podcast that is dedicated to providing our listeners with a broad overview of the global financial markets, including a special focus on the Kenyan markets. And in order to deliver on this objective, we have structured this podcast to begin with an overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 115. And in this episode, we are reviewing the performance of the global markets during the 27th week of 2024. And that is from Monday the 1st to Friday the 5th of July. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the Eurozone, where on Tuesday, Eurostat, which is the European Union's statistic agency, released data showing that headline inflation in the Eurozone had dipped to 2.5% in the month of June. The headline inflation number came out in line with market expectations and was 1 percentage point lower than the rate of 2.6%, which was recorded in the previous month of May. Meanwhile, core inflation, which excludes volatile food and energy prices, stayed put at 2.9% and was just a touch higher than the 2.8% that analysts had forecast. Following the European Central Bank's initial rate cut of 25 basis points that was effected on the 6th of June, investors are now analyzing this latest inflation data with a view to projecting the future direction of interest rates in the 20-nation trading bloc. Moving over to the United States, the minutes of the Federal Reserve's June policy meeting were released on Wednesday and showed that whilst inflation was moving in the right direction, it was not moving fast enough for the Fed to begin cutting interest rates. Even though the minutes reflected disagreement amongst the policymakers, the meeting concluded with the Federal Open Market Committee voting to hold the rate steady at between 5.25% and 5.5%. Federal Reserve officials emphasized that it would not be appropriate to lower the federal funds rate until there is additional information that gives them greater confidence that inflation was moving sustainably towards its 2% target rate. And staying in the United States, on Friday, the Labor Department reported that the U.S. economy created more jobs than expected in the month of June, though the unemployment rate increased marginally. Non-farm payrolls increased by 206,000 new jobs in the month of June, which was better than the market forecast for 200,000 new jobs. Meanwhile, the jobs number for the previous months of May and April were revised downwards, with the May number dropping from 272,000 to 218,000 new jobs, whilst April's number was revised down from 165,000 to 108,000 new jobs. However, despite the better-than-expected jobs number, the unemployment rate unexpectedly increased to 4.1%, which was the highest rate since October 2021 and was also higher than the forecast rate of 4% flat. Additional data on the U.S. labor market was released earlier in the week, when on Wednesday the ADP released its monthly report, which showed that private payrolls edged lower in the month of June, indicating a potential slowdown in the U.S. labor market. The data showed that private sector companies added 150,000 new jobs for the month, which was below the consensus estimate for 160,000 new jobs and was the lowest monthly gain since January. And shifting gears to the U.S. stock market, the S&P 500 rose to a new record high on Friday as the latest jobs report showed an uptick in unemployment and raised hopes that the Federal Reserve will begin cutting interest rates sooner than expected. Both the S&P 500 and the Nasdaq Composite recorded all-time highs during the session as the broad market index advanced by 0.5% to close at 5,567, whilst the Nasdaq Composite gained by 0.9% to end at 18,352. Meanwhile, the Dow Jones Industrial Average added about 68 points to eventually close the session at 39,375. And on a year-to-date basis, the S&P 500 has rallied about 16%, whilst the Nasdaq has increased by 22%. In the U.S. bond market, Treasury yields dropped on Friday as the latest U.S. jobs report showed an unexpected uptick in unemployment, which could spur the Fed to cut rates later this year. The minutes of the last policy meeting indicated that policymakers wanted to see more progress on inflation before beginning to lower interest rates. According to the CME FedWatch tool, traders are now pricing in a 75% chance that the Fed will cut interest rates by at least 25 basis points in the month of September. And in response, the yield on the benchmark 10-year Treasury bond fell more than 6 basis points to 4.28%, whilst the yield on the policy-sensitive 2-year Treasury note declined by nearly 8 basis points to 4.61%. And just for your information, bond yields and prices move in opposite directions, and 1 basis point is equivalent to 0.01%. In the commodity markets, the price of crude oil recorded its fourth consecutive weekly gain as falling inventories confirmed an uptick in demand. Traders have been projecting a tighter market in the third quarter as fuel demand picks up during the summer season in the United States. The price of the U.S. benchmark West Texas Intermediate crude hit a session high of $84.52 per barrel and has gained about 16% so far this year. Meanwhile, the global benchmark Brent crude was trading at $86.54 per barrel and on a year-to-date basis has risen about 12%. In the precious metals market, the price of gold rose to its highest level in the past 1 month following the release of the latest jobs report, which showed an unexpected uptick in unemployment, which in turn lifted expectations that the Federal Reserve would begin cutting rates in September. If the Federal Reserve begins cutting interest rates in September, traders are projecting that bullion could return to its all-time high of around $2,450 per ounce. However, for the week, the price of spot gold was up nearly 2% and eventually came to a close at $2,392 per ounce. In the cryptocurrency market, during a 24-hour period on Friday, cryptocurrencies plunged across the board and shed more than $170 billion in combined market capitalization. The plunge was caused by an announcement that Mt. Gox would begin paying back about $9 billion worth of Bitcoin that it owed to its former clients and users. Mt. Gox was a Tokyo-based Bitcoin exchange that collapsed in 2014 after being hacked and losing about 950,000 Bitcoins, which are currently valued at about $58 billion. According to CoinMetrics, the price of Bitcoin initially slumped to as low as $53,500 before recovering some of its earlier losses and was last seen trading at $56,500 per coin. And on that note, we now change scene to the Kenyan financial markets, and we start by looking at the cost of living in the country, where the overall rate of inflation declined to 4.6% in the month of June, which was the lowest rate since October 2020 and was down from 5% in the previous month of May. The decline in inflation was mainly attributed to a reduction in the prices of select food items as well as the price of electricity. Food inflation declined from 6.2% in May to 5.6% in June, while fuel inflation moderated further from 6.8% in May to 6.4% in June. Meanwhile, core inflation, also referred to as non-food, non-fuel inflation, this remained stable at 3.4%. And staying on the macroeconomic picture, according to the Kenya National Bureau of Statistics, the economy remained resilient in the first quarter of 2024 as it grew by 5% compared to a growth of 5.5% for a similar period in 2023. This growth was mainly driven by a strong performance in both agriculture and the services sector. The agriculture sector grew by 6.1% compared to 6.4% for a similar quarter in 2023, and this was supported by favorable weather conditions and government interventions. Meanwhile, the services sector grew by 6.2% compared to 6.8% for a similar quarter in 2023. Moving on to the domestic foreign exchange market, during the past week, the Kenya shilling appreciated marginally versus the major international currencies as well as the regional currencies. According to data obtained from the Central Bank of Kenya, the official exchange rate for the US dollar was quoted at 128.71 compared to 129.15 the previous week. However, in the interbank market, commercial banks were selling the US dollar within a narrow range of between 130 to 132 shillings. The lowest rate was offered by Stanbic Bank, which quoted the dollar at 130.30, whilst the highest rate was quoted by I&M Bank at 131.55. Meanwhile, the sterling pound was priced at 164 shillings flat, and the euro was valued at 138.82. And on the regional front, one Kenyan shilling was changing hands for 28.69 Ugandan shillings and 20.86 Tanzanian shillings. And to the Rwandese franc, it was posted at 10.16. The shilling now appears to be relatively stable against the US dollar. However, this may just be a short-term consolidation following the successful issuance of the latest Eurobond, which helped the country avoid a potential sovereign default. The fact of the matter is that Kenya's underlying economic fundamentals remain extremely weak, and this is evidenced by the country's excessive national debt, which now stands at above 70% of the gross domestic product and consumes about 60% of total tax revenues. And given these fundamentals, I expect that the shilling will continue to remain under pressure for the foreseeable future until such a time that we get our national debt under control. But as we now all know, there are no solutions to excessive debt, just consequences in the form of higher taxes. On foreign exchange reserves, Kenya's usable foreign exchange reserves declined by $25 million to $7.7 billion, which is equivalent to 4 months of import cover. This level of reserves is compliant with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite the short-term compliance, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and this is further exacerbated by our ever-increasing national debt, which has pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the liquidity situation in the interbank market was adequate and well-funded through open market operations, as the interbank rate dipped by just 4 basis points from 13.30% the previous week to 13.26%. On the back of that, the average value that was traded in the interbank market increased to 24.2 billion shillings, and this was up from 18.4 billion shillings the previous week. Meanwhile, the excess reserves held by commercial banks in relation to the 4.25% cash reserve requirement stood at 17.6 billion shillings. For your information, the cash reserve is a statutory requirement that specifies a percentage of total deposits which commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 4th of July, and the central bank received bids totaling 29.8 billion shillings against an advertised amount of 24 billion shillings, representing a performance of 124%. The central bank ended up accepting 27.8 billion shillings, and the results of the auction were as follows. The 91-day rate ticked up by about 1 basis point to 15.98%, whilst the 182-day rate increased by 3 basis points to average out at 16.79%, and the 364-day rate registered a gain of 3.8 basis points to settle at 16.82%. In the primary bond market, the auction for the top sale of the reopened 2-year Treasury bond was held on Thursday, the 4th of July, and the central bank received bids totaling 487 million shillings against an advertised amount of 20 billion shillings, representing a dismal performance of just 2.4%. The central bank accepted 486 million shillings at a weighted average rate of 17.12% vis-a-vis the bond's coupon rate at 16.97%. And just as a reminder, the Central Bank of Kenya has published a prospectus for its July bond issue and is looking to raise a total of 30 billion shillings through the sale of 2 reopened treasury bonds whose terms and conditions are as follows. The first bond is a 10-year bond with 9.7 years left to maturity and a coupon rate at 16% flat. The second bond is a 20-year bond with 3.9 years left to maturity and a coupon rate at 13.75%. These bonds are now open for sale until Wednesday, the 17th of July. Up next is our topical issue, and this week we are looking at the manufacturing sector in Kenya. The first quarter of 2024 saw Kenya's manufacturing sector post its slowest growth in the past 16 years. The slowdown in manufacturing was attributed to higher production costs as well as a barrage of new tax measures that were introduced by the government. Data from the Kenya National Bureau of Statistics shows that in the first quarter of 2024, the manufacturing sector grew by just 1.3%, which was the slowest pace since the first quarter of 2008, and this was when the sector grew by a marginal rate of just 0.7%. The dismal performance in 2008 was a direct result of the post-election violence that followed the disputed presidential elections of 2007. The manufacturing sector has the highest multiplier effect on the economy and has been touted as the driving force of the next phase of Kenya's economic transformation. In this regard, the government's plan is to grow the manufacturing sector so that it contributes at least 20% to the country's gross domestic product by the year 2030. However, despite this ambitious target, the manufacturing sector in 2023 contributed only about 7.6% to the country's gross domestic product, and this was in contrast to a high of 10% in 2014. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with a friend and help to spread the word around. I really do appreciate your assistance in this effort. And for your information, the Market Color podcast is now available on all the major hosting directories, that is Apple Podcasts, Spotify, and Amazon Music. Please consider subscribing so that you can be notified every time I publish a new episode. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourselves a blessed and fantastic week ahead. And remember, these 3 remain: faith, hope, and love. But the greatest of these is love. 1 Corinthians chapter 13 and verse 13. Think about it. Thank you, and God bless.